For the first time in over a decade, residential real estate across the world has entered into a period of falling home prices. The U.S. housing market is no exception. The streak of 124 consecutive months of positive home price growth, a period spanning from the bottom of the previous bust in February 2012 to the top of the pandemic housing boom in June 2022, has been replaced by a new streak: 4 consecutive months of U.S. home price declines. But is this a sign that the housing market is finally recovering? Or is it just the calm before the storm? According to Fortune, housing prices in October 2022 were 38.1% higher than they were at the start of the pandemic in March 2020. However, according to the Case-Shiller National Home Price Index, prices began to fall in November 2022, with prices down 2.4% from their peak in June 2022. According to multiple sources, experts predict another 10% to 15% drop by the second or third quarter of 2023. Several other factors point to a further drop in home prices. According to Reuters, home construction in the United States fell for the third consecutive month in November. And according to a Commerce Department report, single-family housing starts fell by 4.1% last fall. The market has shifted to be more buyer-friendly, but sellers still hold the majority of the cards. As mortgage rates rise and affordability falls, sellers' expectations may have to shift to match the changing market, and buyers will have more leverage. Despite this, many predict that the market will return to a more balanced state than in recent years. Buyers are discovering that they can buy without waiving contingencies, and sellers are beginning to offer concessions. However, many sellers have low interest rate mortgages and are not under pressure to sell, so they may wait for the best offer. Now, we don't want to pressure you, but if you're enjoying this video, please take a second and hit the like and subscribe button, so we can keep sharing more videos like this with you. While prices have fallen from where they were at this time last year, they are still higher than 2021 prices in many markets. Mortgage rates have risen slightly in December, and offer activity appears to be picking up as buyers return to the market. Currently, inventories are all over the place. In some places, they are double what they were in December, while in others, they are 25% lower. During the fall months, fewer homes were listed, but those that were listed stayed on the market for longer. Furthermore, more homes were taken off the market than usual during this time period. We see this as a relatively fluid market, in which, as buyer activity resumes after the holidays, there are a huge number of homes ready to hit the market once mortgage rates have stabilized. However, rate hikes are unlikely to stop in 2023, according to Marco Smith, a real estate agent with Long & Foster Real Estate in Maryland. He anticipates that interest rates will gradually rise throughout the year. Mortgage rates will remain in the mid-6% range for the first 2 quarters, depending on the buyer's credit, before rising to a maximum of 8% in June or July. However, this prediction isn't entirely negative. He also mentioned that when interest rates rise, prices fall. And because interest rates currently are rising slowly, housing prices are bound to fall, but not significantly. This will not alleviate inventory concerns, but it will increase sales. He also predicts that interest rates will remain between 6 and 8% for the majority of the year. It's also worth noting that the housing market is a complex and constantly evolving entity that is influenced by a wide range of factors, including economic conditions, demographic trends, and government policies. And in recent years, the housing market has been the subject of much debate and speculation, with some experts arguing that it's facing a recession, while others believe that it's experiencing a period of stability or even growth. To understand the current state of the housing market, it's important to examine the various factors that have contributed to its development over the past decade. In the years leading up to the Great Recession of 2008, the housing market was characterized by rapid expansion and rising home values. This was fueled in part by loose lending practices and the proliferation of complex financial instruments, such as mortgage-backed securities that enabled more people to qualify for home loans. In 2007, the housing market began to unravel, as rising interest rates and a wave of defaults on subprime mortgages led to a sharp decline in home values. The crisis deepened in 2008 when Lehman Brothers collapsed and the global financial system was thrown into turmoil. The housing market was hit particularly hard, with home values plunging and foreclosures reaching record levels. In the years following the Great Recession, the housing market began to recover, aided by low interest rates, rising employment, and improving economic conditions. However, the recovery was uneven, and many markets, particularly those that had experienced the greatest price appreciation prior to the recession, struggled to regain their footing. In recent years, the housing market has been characterized by a number of trends that have shaped its development. One of the most significant of these trends has been the rise of the gig economy, which has led to more people working as freelancers or in temporary positions rather than as traditional employees. This has made it more difficult for many people to qualify for home loans, as traditional lenders often require a stable employment history as a prerequisite for mortgage approval. Another trend that has had significant impact on the housing market is the rise of e-commerce and the related shift in consumer behavior. As more people shop online, the demand for retail space has declined, leading to a surplus of commercial properties and a corresponding drop in values. This has also had a knock-on effect on the housing market, as many people who might have otherwise invested in commercial properties have instead turned to the residential market as an alternative investment opportunity. Despite these trends, the housing market has remained relatively stable in recent years, with modest but steady price appreciation and relatively low levels of inventory. Now there are concerns that the market may be approaching a turning point, as continuously rising interest rates and the expiration of certain government programs could lead to a slowdown in demand. There are also concerns about the potential impact of rising inflation once again, which could erode the purchasing power of potential home buyers and lead to a decline in demand. Overall, it's difficult to say definitely whether the housing market is facing a recession or not. While there are certainly challenges and uncertainties that could lead to a slowdown in demand, the market has shown remarkable resilience in the face of numerous challenges over the past decade. Given the complexity of the factors that influence the housing market, it's likely that it will continue to evolve and change in the coming years, with some areas experiencing growth while others face challenges. That's it for today's video. Let us know what you think in the comments section. If you liked the video, don't forget to give us a thumbs up, subscribe for more content, and hit the notification bell so that you can be updated whenever we upload new videos. I'll see you in the next one.